Welcome back to The Bottom Line, the show where we look beyond the balance sheets and algorithms to uncover the true drivers of financial success. I'm your host, John. And today, we're tackling a topic that is often whispered about but rarely discussed openly in the trading world. The enemy within, the ego.
And I'm Sarah. It's great to be here, John. For years, people hire me to look at their trading strategies, their market analysis, and their P&L statements. But 9 times out of 10, the problem isn't the chart pattern they missed, it's the conversation they're having with themselves.
Right. We spend thousands of dollars on technical analysis courses, but maybe zero on emotional intelligence. The premise of our discussion today, drawing inspiration from our source material, is simple. Why do even the smartest, most technically skilled traders fail? And the answer, we argue, often comes down to an overestimation of one's own ability, that dangerous, silent voice of the ego.
Exactly. Think about it. The market is the single most objective entity on the planet. It doesn't care about your resume, your pedigree, or how much sleep you got last night. It only reacts to supply, demand, and narrative. When your ego steps in, it creates a fatal disconnect between the objective reality of the market and your personal perception of it. That's where the trouble starts.
So let's establish the context. Why does this matter now? We're in an age of instant information, instant trades, and massive leverage. Does that amplify the ego problem?
It absolutely does. The sheer speed and accessibility of modern trading, especially with leverage, makes the emotional stakes astronomical. Back in the day, you had time to pause. Now, you can lose 5% of your capital in a minute. When you have a successful trade, the euphoria, that feeling of having cracked the code, is instant. And that euphoria is pure ego fuel. It makes the trader think, I'm invincible. I should double down. That is the market's oldest trap.
Let's dive into the core anatomy of this financial ego. The document highlights a few key biases. Let's start with the confirmation bias. This is something we all do outside of finance, right? Seeking information that validates what we already believe.
It's universal, but in trading, it's devastating. Imagine you've taken a long position on a stock. You believe it's going up. Confirmation bias means you will actively seek out articles and analysts who agree with you. You'll filter out the World Bank report suggesting an economic slowdown or the technical indicator screaming sell. You're creating a mental echo chamber.
So you're essentially insulating yourself from the truth, which prevents learning. You can't adapt if you only see what you want to see.
Correct. And that arrogance then leads directly into the gambler's fallacy and overconfidence. You have 5 successful trades. The ego whispers, see, you're brilliant. You can risk double the amount on the 6th trade. But every single trade is an independent event. The past streak has zero impact on the future probability.
That's a crucial point. It's the difference between a disciplined capital manager and a compulsive gambler. The ego transforms disciplined risk management into a simple bet. I really like the practical tip offered here, the concept of methodical doubt.
It's simple, but incredibly powerful. After a great week of trading, instead of high-fiving yourself for your genius, you list your 3 best trades, and for each one, you force yourself to write 5 reasons why that trade could have failed. You also list 3 pieces of data you chose to ignore. This exercise trains your mind to confront success with humility and reinforces risk awareness. You're celebrating the integrity of your process, not the luck of the outcome.
That brings us to the emotional twin of the ego, fear and greed. These are the primal forces. How does the ego weaponize these 2 forces against the trader?
They are the ego's primary envoys. Greed is often misunderstood. It's not just about wanting more money, it's the inability to accept a small loss. This leads to the most destructive behavior, revenge trading.
The classic scenario. You lose 3% or 5% on a trade, and the ego feels wounded, insulted.
Precisely. The ego says, I must recover that loss immediately. So you override your plan, increase your leverage, and try to win back the 5% in one single oversized trade. That's pure emotional denial. A professional understands a loss is a cost of doing business, an inevitable commission. The ego views it as a personal failure that must be corrected by force. And this is how accounts get wiped out, not by the initial small loss, but by the reckless attempt to avenge it.
And fear, on the flip side, leads to premature selling. The fear of a temporary correction turning into a catastrophe makes people bail on profitable positions way too early, long before their original target is hit.
Yes, and collective fear, like during the 2008 financial crisis, is contagious. The only defense against this emotional pendulum swing is an airtight trading plan. And again, the solution is self-assessment. The document suggests asking yourself 3 questions before hitting the execute button. Am I entering this trade because I have a plan or because I feel like I should? If I lost 100% of this position, would it change my lifestyle? And can I justify this decision only with my analysis, or is there a hunch involved?
I love that pause. It gives your rational mind a vital space it needs over your impulsive ego. So how do we build that muscle of emotional discipline? It's not innate, it has to be trained. The document points to 2 strategies that are cornerstones of professional trading. First, the trading journal.
The journal is the most underrated and powerful tool you have. The amateur trader only logs the winning trades. The professional logs the process and the emotional state. You need to record, did I follow my plan 100%? What was my emotion going in? Was it euphoria, frustration, or just boredom?
Boredom being the goal, right?
Absolutely. If your journal consistently shows that your profitable trades happen when you're bored, meaning you're following the plan without emotion, and your losses happen when you're euphoric or frustrated, meaning the ego is driving, the correlation becomes undeniable. The journal forces humility because it shows you the data.
And the second cornerstone is the 1% rule of risk management. This seems like the most tangible manifestation of financial humility.
It is the ultimate insurance policy against arrogance. The principle is simple. Never risk more than 1% of your total trading capital on a single trade. If you risk 1%, you would need 100 consecutive losing trades to wipe out your account. That's statistically remote. If you risk 5%, you only need 20 consecutive losses. By limiting the acceptable loss to something negligible, you remove the emotional pressure. The loss is insignificant, so the emotion attached to it is also insignificant. That's how technique directly supports psychology.
We need to zoom out for a second and look at the bigger picture, the macro context. The ego is fed by the illusion of control, especially when facing entities like the Federal Reserve or the IMF.
It's the grand illusion. Studying the Fed or the IMF is essential, but the ego makes you think, I know exactly how the market will react to the CPI data. Humility says, I have a strong hypothesis based on historical data, but I'm prepared for any of the 3 possible market reactions.
It's the difference between being a small sailboat that adapts to the massive weather patterns, the Fed and the IMF being those currents, and being a stubborn vessel that fights the hurricane.
The ego hates adaptation. It falls in love with one direction, say, the dollar can only go down, and refuses to change course even when macro factors demand it. That's when traders get blindsided by what Nassim Taleb calls a black swan event. The unexpected high-impact events like a pandemic or a sudden credit crunch. The ego's reaction to a black swan is denial. My analysis was correct. This shouldn't be happening. That denial keeps them holding onto losing positions, hoping the market will return to normal.
The humble response is to accept the new reality and cut your losses. Which brings us to our final practical tip, diversification and detachment.
Diversification is the strategy of the humble. Concentration is the strategy of the ego. Don't put all your eggs in one asset class. Use the rule of 3 baskets, low, medium, and high risk. This protects your core capital from a mistake in your high-risk allocation. And most importantly, do not marry a position. Your goal is to grow your capital, not to prove you are right about one specific stock or crypto coin. If the investment thesis changes, you move on without sentimental attachment.
That's a powerful final thought. To summarize the core lessons from today.
Lesson 1. Be a scientist, not a prophet. Base your decisions on verifiable data and always be willing to refute your own hypothesis. The ego wants to be right, the professional wants to make money.
Lesson 2, humility is your stop loss. The 1% rule is your defense against arrogance, ensuring that any emotional damage from a loss is minimal.
Lesson 3, document your process. Your trading journal is the compass that keeps you honest, recording the why and how of your decisions, not just the result.
The market is the ultimate master of humility. Every loss is a lesson on where your plan failed or where your ego took the wheel. Sarah, thank you so much for breaking down this crucial aspect of trading psychology.
My pleasure, John. It really boils down to this. Investing in your character is the most profitable decision you will ever make.
Absolutely. And to all our listeners, we invite you to reflect on your last impulsive trade. Was it an analysis error,